Swayam Prabha. Digital India. Educated India.
Hello, my name is Atul Tripathi and I am an honorary adjunct fellow at National Maritime Foundation. Welcome all to this series on ESG analytics and green finance. Today we will be talking about climate risk, insurance underwriting, both the personal as well as the commercial side of the game. So let's get going on this area. First, underwriting and its impact. So the impact is about turning the risk assessment into a very much a climate action. What are the next steps that one needs to take place? Therefore, every underwriting decision is going to shape the climate resilience, both from the economics aspect as well as from the insurer's aspect, because that's what is about absorbing risk and then re-engineering it out. Because as per the insurers, the influence on more than $30 trillion in economic activity through the underwriting and embedding the climate metrics here can accelerate the global decarbonization factor. This is as per the United Nations Environment Program and Principles of Sustainable Insurance, PSI 2023 report. Therefore, it's very interesting and important to understand that in this climate smart underwriting is becoming a complete game changer or a game lever, as we call it. Therefore, the underwriting is one that is going to define who gets insured, what is the cost, what are the processes involved, how do you make this a very powerful mechanism to reward your low carbon resilient behavior, incorporation of your ESG and emissions data in the underwriting model that is aligning with the financial incentives with the climate goals. So let's say case of when you're offering a premium discount to renewable projects or resilient infrastructure, which is lowering your risk exposure as well as the emissions intensity. That is the kind of work we are looking at in terms of the underwriting. And therefore, what is driving the measurable resilience outcomes when you look at it, it's got three focus. One is the resilience focused underwriting. Two is directly translating to lower cost ratios and faster post-disaster recoveries, because the World Bank is estimating that about $1 invested in resilience is saving about $4 to $7 in the recovery cost we're looking at. The steering of the emissions through portfolio alignment is got another important point with respect to the underwriting. And therefore, the Net Zero Insurance Alliance, NZIA, is enabling the insurers to measure and report your insured emissions, mirroring investors' financed emissions. And therefore, the insurers can then calculate and reduce the portfolio emissions intensity by A, exclusion through high carbon sectors, B, supporting clients' transition plans, and C, embedding the client scenario analysis in risk pricing. So these are the three different factors that one looks at. And the feedback loop, when it comes down to, it's all about the risk to reward ratio that we're looking at. Therefore, the climate aligned underwriting is the one that is going to reduce the systemic risk, protect from insurers' balance sheet and societal resilience. These are, again, two important things. And then it is going to integrate the transition risk assessment and adaptation incentives, while the insurers can actively shape a low carbon economy. That is the focus as far as turning the risk assessments into the climate related action, because the outcome is now in terms of measurable reductions in the physical risks that is coming in terms of the resilience, and the transition risk which is coming in the form of emissions. The next and important point in the similar regard is around the impact of underwriting and the levers that is there around the green finance insurance design framework, because you see, around 8% of global climate-related economic losses are insured. That's the only thing, about only 8% of them. And therefore, the impact of the underwriting is the one that is going to bridge the protection gap while providing emissions target. This is as per Swiss Re Institute 2023 report. You see, the underwriting is becoming very much a climate lever, as I talked about a few minutes ago, because underwriting decisions, they are directly determining which activities, sectors, technologies they are the ones that are going to get the financial powers, financial recovery, liquidity is going to be high. This is the power that is going to make the underwriting a hidden driver of the climate and resilient outcomes, and the insurers can then accelerate or stall the transition pathways through their own portfolio designs. Take the case of example of pricing the flood exposed or carbon intensive industries which are higher. How will the insurers send market signals that is going to encourage your adaptation and decarbonization? You're going to reimagine your entire pricing sustainability or the approach that you need to take care of, because you're moving beyond your traditional risk pricing and integrating into ESG scores, your carbon intensity and the climate vulnerability now into the insurance portfolios. Therefore, and the pricing models, and therefore, your premiums are becoming more behavioral nudge, because the firms are now investing in green infrastructure or adopting mitigation by adopting various latest technologies in terms of artificial intelligence, GIS, blockchains of the world. So this approach actually is internalizing the true cost of climate risk into the entire financial system, because the coverage as a catalyst is becoming the transformation when one is looked towards, because green insurance coverage goes beyond the asset protection. It is about enabling the deployment of clean technologies, and you're going to reduce your operational and financial risks. The ensuring your renewable projects, carbon capture assets or EV infrastructures is the one that is going to make the sector bankable, and it's there you're going to unlock your private capital for the net zero transition, because the advanced examples, some of them include policies for battery performance or hydrogen leakages or even the carbon offset integrity. And, when you look at the exclusion and the transition clause, the strategic exclusions are not punitive. They are portfolio risk management tools, and they're aligning the insurers with the future market trajectories, because that is where, the phasing out of all kind of assets which are high carbon emitters such as oil or coal are coming into picture, and the deforestation linked projects, which is where it is helping the insurers to be future-proof portfolios and reduce the stranded asset risk. The risk engineering for resilience, when you look at it, that problem of green insurance design frameworks, it talks about insurers increasingly acting as a risk advisors and not only risk takers. That's the entire transformation from taker to risk advisor. That is what the entire transformation has all been about. And through on-site audits, through climate risk modeling, adaptation of consultancy, insurers are then guiding their clients toward resilient infrastructure and adaptive changes, because this dual benefit is going to lower your loss ratio for insurers, and higher climate resilience for clients is going to create a measurable shared value. And therefore, data and analytics are becoming a big enabler in this direction, because the next frontier is data-driven underwriting, where you're going to combine your satellite imagery, IoT, sensor data, and AI climate models. An example, something we'll look in a few minutes down the line, in the similar vein. So these tools are then going to allow the insurers to quantify your risk dynamically and integrate your real-time emissions data, measure your insured emissions. So the green insurance product innovations take place. So the green insurance is now being designed for both the protective as well as incentivizing your sustainability. And some of the examples, when you look at it, is in terms of the parametric climate insurance, again, something we'll talk about in a few minutes down the line, where you're paying out automatically when a climate threshold has been breached. So it can be in terms of the rainfall or the temperature, even ensuring your faster recovery. Then it is about your resilience linked premiums, where you're lowering your rates for investments in flood defenses or energy efficiency upgradations with respect to that. Thirdly, as an example, it can also be used in terms of the carbon reduction guarantees, particularly in terms of the coverage contingent on the verified emissions and reduction of the process or the progress that is going to be taking place. That is another important point and few focal areas when you're looking at that designing a framework for the insurance. And another important point on the similar lines is about sovereign catastrophe models, where you're building the financial resilience through data-driven risk sharing. Something we just talked about, data and analytics as an enabler in this direction, because one country alone cannot absorb the climate shock. It's just not possible. This is an environmental problem that's across the world. Therefore, together the nations are going to turn the volatility, and they're going to have a collective resilience around it, because in the first 15 years of the operation, CCI RIF made 62 payouts totaling of $293 million, often within 14 days of an event that has occurred, So therefore, the concept of sovereign risk, concept of sovereign catastrophe models is becoming very important, which is talking about, multi-country insurance mechanism that is allowing the member nations to share and transfer disaster risks completely and collectively. And the goal is to stabilize your public finances while providing your rapid liquidity post-disaster, reduction in the ad hocism in terms of the donor aid. And some successful examples in this regard, and we have also talked in the past, is CCRIF, SPC, that is your Caribbean cases, ARC, African Risk Capacity, CDRIF, Southeast Asia Disaster Risk Infrastructure Insurance Facility. The mechanisms of this entire risk pooling is based on four fundamental principles. One is the risk pooling principle, two is the risk retention, three is risk reinsurance, and fourth is the capital market layer. Let's look at each one of them in a brief. So when you look at pooling principles, it's about countries that are going to contribute premiums to shared risk pools, diversify across geographies and perils, and reduce your cost of coverage. Risk retention is all about each country retaining a layer of losses, which is going to be above the pool, and reinsurance layer is going to be activated. Reinsurance layer, when you look at it, is the pooled fund purchases, aggregate insurance protection, and leveraging the economies of scale to negotiate much better terms. And finally, when you look at the capital market layer, it's about, in some pools, what is going to happen, the catastrophe bonds or ILS, or insurance-linked sustainability bond securities, they're going to provide you your top layer coverage for extreme events. And therefore, the trigger mechanisms are again an important integral part in this similar game, because the parametric trigger can be one of the models that can be adopted. The model loss triggers, where you're based on a catastrophe modeling of exposure and hazard data to estimate your expected losses, can be another example. Similarly, the case of hybrid triggers can be another example, because when you look at it from the perspective of, as an example, if you take the case of African Risk Capacity, they're using satellite-based images to find out, the rainfall data so as to trigger your payouts, to figure out the droughts, when the drought is going to, when the water resistance satisfaction index is going to be dropping below a threshold. The risk layering for the financial efficiency, another thing that we're going to be talking about more in detail in coming few minutes. It's about three different layers. So layer one talks about country retention, layer two is about pool layer, and layer 3 is about reinsurance or ILS layer. When you look at layer 1, which is about country retention, it's about self-insured buffer through budget reserves or contingent credit, and layer 2 is about pool resources, where you're looking at in terms of shared coverage among the member states, and they're absorbing their moderate losses. And layer 3 is about reinsurance or ILS layer, which is where you're looking at protection against rare and catastrophic events. And this layering is the one that is going to ensure your cost efficiency, because your routine losses are going to be absorbed locally. The catastrophic shocks, they're going to be globally diversified. Therefore, again, the role of data preparedness, prerequisites, and modeling foundations are becoming very important, because high quality hazard exposure, vulnerability data is the one that is going to the underpinning for the trigger design and pricing, and therefore this is requiring the integration of satellite-based hazard maps, historical loss data sets, socio-economic exposure data such as GDP, population, infrastructure, probabilistic catastrophe models in terms of flood, cyclone, drought modules, continuous data sharing and model calibrations there. That's another important point as far as very critical to maintain the fairness and the actuarial soundness is. Therefore, the new emerging trend is towards your AI-enabled parametric calibration, where you're looking at data which is going to be triggered off. Any triggers are going to be taking place with respect to your AI-based models, which are going to be parametrically triggered. And the next thing that brings us to a focus on the line is understanding what exactly is climate risk, and how will you, why is it becoming the new frontier for underwriter, and what is the intelligence around that they need to take care, because climate risk is not about the future problems, because globally climate related insured losses have quadrupled since 1980s, and it's reaching to $120 billion annually. This is as per Swiss Re Institute's report 2024. So therefore, you see the physical risks that are coming in terms of the core exposure drivers, such as your result from the acute events such as floods, hurricanes, hurricanes, wildfires, and then the chronic shifts that are happening because of this thing in terms of rising sea levels and droughts. They are affecting property, agriculture, insurance, health lines, and most significantly, and therefore the underwriters, they need to understand the increasing claim frequency they're looking at, demand calibration of catastrophe models, and loss distribution. And therefore, the requirement is to integrating your forward-looking climate scenarios such as RCP 4.5 and SSP2 instead of just relying on solely on your historical data. So, for an example, in 2021, when the European floods actually happened, it resulted in about $46 billion in economic losses, with only 36% being insured. That is as per Munich Re's report in 2022. And therefore, the transition risk, in terms of policy and market shocks are set in motion, because this is where the emergence this is emerging primarily from the regulatory changes, the technology disruption, and the shifting of the vendor and investor behavior as the economies decarbonize. And therefore, the underwriters must monitor your carbon pricing mechanisms, the phase out of the fossil fuels, the stranded asset exposures, which are coming in terms of the coal plants, outdated industrial facilities. The transition risk then going to alter your liability and credit exposure across energy, transport, heavy industry sectors, and therefore the next point that comes around is in terms of the liability risk, which is your litigation frontier. With the growing exposures, the climate related lawsuits are targeting corporations, governments, and even the financial institutions for inactions or misrepresentation of data or information. And therefore the underwriters, they're going to now face emerging liabilities in directors and officers, your professional indemnity, the environmental impairment. So take the case of 2023, over 2,400 climate related court cases were filed globally. This is as per United Nations Environment Program Global Climate Litigation Report 2023. So a large number of cases have started to rise because of these liability risk that is becoming your litigation factor that needs to be taken care of. And in order to handle this problem statement, primarily the use of data and modeling foundations become very important for climate underwriting, because it is here that the high resolution hazard maps, your probabilistic modeling and scenario based stress testing are now underwriting your essentials. Therefore, you're integrating data from multiple sources. Take the case of Copernicus climate source data, which we have already discussed, one of the previous lectures. NOAA's climate data online, again, something we've discussed and shown and gone to the websites and understood what we're trying to do. Then IPCC ARC6 physical risk projections. So the underwriters, they now must collaborate with the climate scientists and actuaries and data engineers and data scientists to even continuously refine their exposure of the data that is happening. Therefore, the strategic implications are becoming very important for the insurance, underwriting the insurance portfolios, because you're moving from reactive loss pricing to proactive climate adaptation financing, and then embedding your resilience metrics from flood defenders and building retrofits to premium pricing, because you're looking at developing climate linked insurance products such as parametric or resilience resilience coverage altogether. In the similar lines, we come down to another important point, and that is the climate risk. And why is it two-faced? Because we're looking at the physical as well as the transition shock, something that we discussed a few minutes ago. So the physical risk is about changing the climate conditions to extreme weather events, and then the transition risk is about policy changes, sudden impact on the technological innovation and the social adaptation, the kind of impact that it is going to be having on the pricing, demand, stranded assets, defaults on loans. And that is also going to come to the fact of liability risks, the very you're looking at stakeholder litigation and regulatory enforcement, because the business disruption is resulting from litigation, and therefore the penalties are going to be very high in cases of litigation, because up to 30% of global insurance losses by 2040 could stem from transition shocks and not from the physical damage. That's very important, because as the policy and technology shifts, they're going to be reshaping the entire asset volume. This is again as per Swiss Re 2024 report. So understanding the two dimensions of the climate change is very important. That is where the physical risk and the transition risk become very important, because the physical risk is all about losses from the tangible climate events. It can be storms, floods, hurricanes, tsunamis, all the various factors. And the transition risk can be the risk that is emerging because of financial and the technological and the legislation that is going to be arriving because of the exposures from arising from the policy, regulatory, technological shifts, towards a low carbon economy. Therefore, both the channels alter the underwriting assumption, and they're changing loss frequencies, your asset valuations, and the portfolio correlations. And therefore, the physical risk, which is your tangible shock, we are looking at acute perils, sudden or high impact events, chronic perils can exist in forms of your rising sea levels, increasing the mean temperatures, prolonged drought, which is termed as your gradual environmental shifts. Therefore, and the underwriting implications for both of them can be in terms of increased catastrophe loss frequency and severity, accumulation risks in the exposed geographies, for example, a coastal property, wildfire zones, necessity of forward-looking hazard models, and climate-adjusted return periods is very important. Because take the case of 2023 wildfires that took place in Canada. Around $7 billion of losses were losses, and therefore this altered the very nature of reinsurance rates across the globe. The transition risk is more about your intangible shocks that are going to come across. Particularly, it is going to arise when there's going to be a policy action, technology innovation, or even market reevaluation as economics decarbonize. And the primary sources are going to be from, carbon taxes, your emission standards, fossil fuel phase outs, rapid adoptions of renewables such as EVs, hydrogen, disruption in legacy sectors, investor disinvestment, green premium shifts, your stranded assets. The implications in this case would be around your shifting of the liability risk, changing the insured asset values and business model viability, and, in need for the dynamic pricing models and incorporating them in the very pathways of ESG scores is becoming very important. The common denominator for both of them is going to be the transition into the underwriting. That's where the common denominator for both the physical as well as the transition risk is going to be across, because you're looking at pricing, which is going to come from adjustment of the premiums based on exposures and ESG alignment, the accumulation, which is going to be monitoring your correlated exposures across sections or sectors, regions, the coverage terms, which is going to redefine your exclusions, sublimits, or even your resilience-based discount, because the physical risk is going to challenge the historical loss data, while the transition risk is going to challenge the valuation and the liability of the assumption. So together they demand scenario-based and data-integrated underwriting, which is going to blend meteorological, financial, and policy data sets. Again, in this area as well, the role of data and analytical needs is going to be high, because, or rather, it's going to change completely, because the underwriters now need cross-domain information or data you're looking at in terms of the hazards and the exposure on the map, say, again, coming from Copernicus and OAs and Swiss Re's CatNat. Again, something we have seen in the past as well. The emissions trajectory, the carbon pricing models, and such as NGFS is a very popular one, and the legal and the regulatory data sets for climate liability mapping. Therefore, all these factors are going to be bringing together your physical to the transition and the liability risk. Having said that, there's a myth this state that the entire risk is very stationary in nature, while actually, if you look at it, it's no more. It's about predicting the future, So there's going to be a complete shift, as you can clearly see in this particular diagram. The complete shift from the previous climate to the current new climate model, because every time a lot of changes are taking place. Because yesterday's 1 in 100 flood is actually today's 1 in 20 flood, and that's the truth. This is again coming from the Swiss Re Institute of 2023 report, and therefore, what is non-stationary? Something we need to understand. It's a very important and a very implicational area, because traditional actuarials and catastrophe models, they assume stationarity. That's not being stationary in nature. That is where the hazard frequency and the severity of the distribution remain constant over the time. The climate change is the one that is breaking this assumption, because the global temperatures are rising. There is a change in the precipitation patterns, and the shift is taking from storm tracks mean that the historical averages are no longer representing your future probabilities. Therefore, it is disrupting or distorting your risk underwriting, because the historical baselines and the understating of the tail risk, which is dependent on your past data, is missing the compounding effects and the loss of exceedance curves that have been built on the backward looking data is actually failing to capture new frequency intensity regimes. So take the case of 2022 floods in Pakistan, which was statistically 1 in 100 year. But however, based on the conditions and under 1980 conditions, you're looking at 1 in 25 frequency is what you're looking at for the floods in Pakistan. Therefore, incorporating your trend factors into underwriting models, where you're going to replace your static hazard frequency with trend adjusted and forward looking hazard models, which would include your warming rate, sea level rise, urban expansion, infrastructure adaptation. You've got the blended historical data with the climate and model outputs, so as to recalibrate your probability models is becoming another important factor in this entire shift that is taking place from your old models to the new models, the climate models which are no more existing, or rather have changed, completely shifted from towards the right. So the accounting for the correlated second perils, such as your non-stationary systems, they're going to create new correlations. So the heat is going to come from drought, which is going to account for wildfire. All this is going to be linked together. Therefore, another example can be in the similar regard is a storm, and then accounting for your flood, and therefore resulting in the landslide. All these factors, all the events have got to be taken into consideration, because underwriters now must model the multi-peril compounding effects rather than the isolated perils that they're looking at, as we just spoke a few seconds ago, from storm to your floods to your landslides, from heat, extreme heat to drought to wildfire. So now a lot of these compounded effects have started to take place, and therefore the incorporation of your adaptation effects, both in terms of human adaptation, say flood barriers, building codes, crop shifts, is going to modify your vulnerability curves. And non-stationary is not only only hazard driven, but it's also exposure and the vulnerability driven, because the underwriting implications is going to be huge for these cases, such as move from your historical calibration to scenario based modeling, where you're integrating your trend factors with the adaptation metrics and the correlated peril linkages into pricing and portfolio strategies. All three of these factors are going to be combined together so as to develop dynamic exposure scoring systems, so that you can reevaluate your annually against the climate data updates, and transition from backward validation to forward validation using various ensemble methods. Climate projections is what world of insurance has moved towards in terms of particularly the underwriting factor. Therefore, designing this kind of a product can be an important factor, because this is where you're going to be building your resilience, because the underwriting strategy is the one that is going to mitigate your insured risk. And the goal is to have a climate change adaptation and climate change mitigation. Adaptation in terms of reduction of the impact of the climate change, mitigation because they're going to reduce your GHG emissions. So both of them as a goal has to be achieved from your risk-based principles or the actuarial risk-based principles, because the core idea of insurance as a behavioral nudge is becoming more important, is becoming a very important point, because traditional underwriting prices a risk where the impact of the underwriting prices are the behavioral fact. And when you're using a product design, then the contractual levers, the insurers can then financially reward the verified mitigation and mandate the adaptive practices as prerequisites for coverage itself, because the product design for resilience comes from three factors: modular climate resilient coverage, which is add-on endorsements for green retrofits, renewable energy backups, water ingress protection. The second one is around parametric features triggering for the payouts for early adoption actions such as pre-storm preparation. Third is around hybrid insurance finance models, which is where you are combining your protection and concessional financing for resilience upgrades such as roofs or barriers, and therefore the pricing of the credits and the protective positive reinforcements is another factor that needs to be taken into account, because the premiums or the discounts or the lower deductibles for verifiable risk reduction actions such as installing fortified roofs or elevating structures above the flood base levels, defining defensible wildfire buffers, or even maintaining the drainage infrastructure is the one that is talking about in terms of pricing of the credits as a positive reinforcement, because the data verification tools such as IoT sensors, drone inspections, municipal resilience certifications is going to be important. The data or the dynamic pricing is going to be adjusted annually based on the sustained mitigation measures or even the updated hazard data, because the continuous precedent is there as far as the risk discipline is concerned, because you're embedding your adaptation compliance clauses into various policy terms, whether in terms of the coverage contingent, maintaining flood barriers or fire breaks, renewable air conditional upon submission or resilience audit reports, a use of micro insurance for your, I would say, the insurers and the policy holders share adaptation or duties, and ensuring long-term alignment between the various underwriting assumptions and the insured behavior that may have taken place, because this is where the systemic impact is coming into picture, and which is beyond individual policies, because of widespread use of incentives such as resilience dividend, where you're lowering your aggregated losses ratios, stronger resilience reinsurance appetite is taking place, more stable premiums are being created, empowering of the SMEs and communities adoption before disasters and not after is the one that is going to be taking place. Therefore, one looks at resilience linked pricing on the similar lines, where you're turning your standards into the savings, because insurers are now deserting. Take this case, the insurers have now started to desert the homeowners in climate which have got shock, which are only shock worsening, So as per this report, 2018, nearly 2 million home insurance contracts nationwide have been dropped, and this is as late as 2023. So the risk reflective pricing through certificate standards talks about underwriting the models that are increasingly embedding certified buildings resilience standards such as IBHS fortified homes or LEED resilience or FEMA flood resilient design codes into the premium structures. These certifications then allow the insurers to differentiate between unmitigated and mitigated risk, so that they can align the premiums with the real world hazard performance rather than the legacy based loss data. Take the case of as an example, the property with IBHS fortified gold certification can see a 10 to 20% reduction in the premiums with the windstorm related premiums, particularly. So the verified installation is acting as your new risk baseline. There's a certification alone is just not enough. It's about verification mechanisms. So that can come from the third party inspections, drone imagery, IoT based proofing of the installation, ensuring that the adaptation measures are genuinely implemented and they are maintained also. This is creating a trust layer in underwriting where there's a reduction in adverse selection and enabling of the insurers so as to price the confidently based on verified resilience rather than just stated intentions across the board. And therefore, embedding your financial incentives for mitigation, the next important point that one needs to cover, because it is here that the premium credits where you're offering your policy holders who are meeting certain recognized resilience criteria, such as your elevated structures in the flood prone areas are taking place. You have a deductible modifications which is coming from your lower deductibles. You're rewarding a sustained risk reduction, higher deductibles where you're applying your non-compliance or poor maintenance using your hazard exposures. And then the empirical evidence for the loss reduction, or based on studies from IBHS and IBS, which is coming from the United States, is indicating that implementing your resilience measures for the fortified roofs or raised foundations can cut catastrophic losses by 40 to 60%, and therefore the quantifiable reduction is increasingly being embedded in the actuarial models, which is proving more premium discounts for financially adjusted by risk reduction or not marketing of the incentives. Therefore, the broader systemic benefits for the insurers, and there's a broader incentives for the systemic insurers and all, and the communities at large, because when you're looking at large portions of community, they're adopting your certain certified standards, as we just talked about a few seconds ago. The insurers are benefiting from this improved portfolio stability, and therefore your reinsurers are gaining confidence more in terms of the model reliability, and therefore there's a complete strategic shift from the reactive to a preventive of the business of economics of in terms of the insurance, because the underwriting process is now started to evolve from your assessing losses after the effect to engineering your situations or resilience within the simulation world to us to gain understanding before the peril actually hits. And therefore this is representing a complete shift from the impact in the world of underwriting, where the pricing is becoming more of a policy lever for sustained behavior and adaptive insurance, and therefore gaining confidence of the reinsurers as well. And therefore, on the similar lines, when you look at it, it comes from the data-driven underwriting, which is talking about the use of telematics, and you're trying to turn your behavior into a climate and a safety dividends, because telematics-enabled insurance can cut claim frequency by 20 to 40%, carbon dioxide emissions by 15% through improved driving habits, as an example, for particularly case about driving. So your behavioral economics is where your sustainability are meeting, because usage-based insurance or UBI is being applied for real-time behavior data such as distance, speed, braking patterns, idling time to personalize your premiums. Drivers are financially being rewarded for sustainable and safe driving, and you're linking the underwriting directly to the environmental outcomes. And this is shifting the insurance from static risk to dynamic risk prevention, which is very important, and the carbon accountability. And therefore there is a reduction that is taking place via various telematics approaches in case of a driving, in case of cars as an example. So the aggressive driving patterns, they can increase your fuel consumption, and hence the emissions are going up by at least 20 to 30%. Studies have shown in this regard. Therefore, in the fleet level telematics adoption in commercial vehicles have shown that there is the fuel saving of 10 to 15% upwards, and a measurable scope 3 emissions reductions for corporate ESG reporting. Therefore, the climate as a data, as an asset, it is what is becoming. So therefore, the telematics is providing you, the insurers, with a rich data sets for climate risk modeling, urban planning, mobility across the to present true analysis. You have the aggregated insights that are helping you to quantify transport sector risk mitigation potential, and is feeding into the insurers, whereas the decarbonization disclosures under TCFD and PCAF frameworks are concerned. So this brings us to another example of the, how there's going to be trust that is going to be created in the world of underwriting and insurance from the use of telematics as a data. Now let's take the case of example of a motor insurance models that are there. By 2030, connected vehicles could generate about $750 billion worth of business in annual data-driven insurance revenues, which is going to transform your underwriting into sustainability service. So that is coming from McKinsey Future of Connected Mobility report in 2023. And so IoT is emerging as the new underwriting fabric, because the IoT sensors in EVs and connected cars are the ones that are delivering the continuous data streams on the driver's behavior, the energy use, the maintenance patterns, and even the route emissions that are taking place. So this shift is underwriting from probabilistic risk models to observed and real-time risk ecosystems, where every insured vehicle is a sensor node in the insurance's climate intelligence network. And therefore, the integration of EV data and carbon scoring is coming into picture, and result which is primarily coming from EV telemetrics, where there's the battery efficiency and the charging patterns, the renewables of the charging percentage is being taken into consideration, enabling your carbon adjusted pricing and rewarding the greener charging behaviors and efficient driving. The carbon scoring algorithms now quantify the carbon dioxide emission intensity per kilometer, which is feeding both the premium adjustments and the insurer's own ESG disclosures under the various frameworks like PCAF, which stands for Partnership for Carbon Accounting Financials, and the smart contract coming for verifiable incentives, because the blockchain-enabled smart contracts are automating your premium adjustments and your carbon rebates based on certain verified IoT data, eliminate certain disputes or even the manual validation processes. So take the case of an example of a driver who's consistently achieving about 20% below your fleet average emissions, which is going to automatically trigger a premium rebate or even a tokenize the sustainability cost that is to be credit rather that is to be taken into consideration. This is actually bringing in a lot of trust and automation to drive underwriting, where sustainability itself is becoming self-verifiable. So the ESG impact on underwriting is becoming more of a practice, where the ESG linked motor insurance is integrating with your social, such as road safety, environment, such as emission reduction, and governance, such as data transparency pillars altogether. This is a very classic example of a use of ESG pillars together to harmonize the information and produce an underwriting report around the use of telematics and IoT sensors. So therefore, this is bringing in a complete strategic advantage and market transition, because the model is creating multi-dimensional value for the policyholders in terms of lower premium, automation of the incentives, ESG alignment of branding. For insurers, it is leading to reduction in loss frequencies, new revenue streams, carbon-linked financial instruments. For regulators, it is more in terms of the verifiable impact data alignment with EU, SFDR and TCFD and India's BRSR, plus the other frameworks that are there. So ultimately, the IoT-linked ESG underwriting is repositioning the insurers as enablers of sustainable mobility transitions, and not just as a risk manager. So the world of parametric add-ons, as we call them, or the parametric use, is becoming very important in the similar regard, because this is where the new shield is coming in terms of loss amplification. Because the rationale for this liquidity is becoming a resilience. So post-disaster cash flow continuity is going to determine the survivability. Delays in claims is going to only amplify losses through halted operations, migration, and asset degradation. Therefore, parametric add-ons is going to address this by providing instant liquidity, which has been tied up to measurable event parameters rather than just the damage assessment. And this works in terms of the trigger-based parameterization. There's going to be a parametric trigger which is going to activate a certain set of pre-agreed conditions which are going to be met, and therefore there is going to be activation in terms of the parameters. The payouts, then they're going to be automatically done, and they're going to be distributed via digital platforms or mobile wallets within hours, and they're offering rapid recovery for households, SMEs, and governments. This is going to avoid any moral hazard and administrative lag that is there. It is going to reduce your loss amplification, because loss amplification is going to occur when secondary impacts such as supply chain disruptions, economic slowdown, health effects, they're going to cascade for it after an event. Rapid liquidity is then going to prevent these compounding effects by measuring your immediate working capital, your infrastructure repairs, and the livelihood protection. And therefore, there's going to be an integration into a traditional policies like your parametric models. They can be layered atop indemnity covers, particularly for the high impact perils like hurricanes, earthquakes, floods. This hybrid model is going to enhance your liquidity and maintain detailed indemnity protection, because the best of both worlds is now coming to picture, and the ESG and the sovereign relevance is becoming more important in the similar lines, because the rapid payout mechanisms, which is aligning with your goal, SDG goal of 13, which is around climate action, and SDG goal 11, which is around resilient cities. This is where the strengthening and the social protection of the systems is taking place. This is because the sovereign risk tools such as ARC, CDRIF, they are already using parametric structures to support climate vulnerable economies and showing a clear impact pathway. So for insurers, such solutions are demonstrating the impact underwriting and measuring the resilience outcomes which have been tied up to the payout speed and your liquidity ratios. The sustainability linked insurance are the ones that are turning your KPIs into a premium power, because when sustainability performance becomes quantifiable, the premiums are the ones that are being rewarded all the time. Mark of a responsible risk, because from static pricing to dynamic ESG incentives is what this is all about. The traditional underwriting models, they're focusing more on the past loss performances. The sustainability linked insurance introducing more of a forward-looking behavioral incentives, because the premiums are now going to be adjusted based on verified sustainable KPIs such as energy intensities, which is going to be measured in kilowatt hour per unit of output, water leakage rates, carbon intensity per ton produced, waste to recycling ratios. Now the contracts are defining your baseline performance thresholds and improvement of the targets. Exceeding the targets leading to premium discounts, while underperforming of the trigger is going to ratchet and increase completely. So you see, when out here, from resilience to competitive advantage, there is going to be a complete premium. You look at it in terms of 11.7% increase, reduction in your premium to about 2x water damage and sublimits, So there is a lot of saving and around taking place. Verification and transparency is becoming very important, because to prevent greenwashing and data verification is very, very critical. Because IoT sensors is the one that is going to track your real-time metrics in terms of energy, temperature, flow rate, while the blockchain-based ESG oracles are going to ensure data immutability and transparency. And the third-party assurance is going to provide you validation in terms of KPI accuracy, audit compliance, and this is going to ensure your verifiable impact, which is going to create your trust in sustainability performance linkages. The risk and capital implications are going to be immense, because the companies can now, with measurable ESGs improvements, demonstrating lower operational volatility and reduction in exposure to transition risk, are justifying the capital relief or improved reinsurance term. The regulators and reinsurers, they are increasingly viewing ESG contracts, the risk mitigation tool, which is aligning with your EU taxonomy, SFDR, India's BRSR in disclosures. And this is promoting your capital efficiency while embedding the sustainability account, providing your product innovations in terms of developing modular add-ons such as carbon reduction clauses, water efficiency credits, the increase in the data ecosystem where you're building your ESG data partnerships for real-time verification. There's a reduction in the reputation damages or reputation leverages are taking place, because the position of the sustainability enabler, not just as a risk absorber, and the ultimate outcome is in terms of the impact underwriting is becoming more measurable, verifiable, and most importantly, it is becoming more financially materiality-based activity, resulting in various savings for the corporations as well. The sovereign risk pools is in the similar lines, where you talk about, no nation, rather collective shields for the climate resilience, because there's no single nation that can have a self-assurance or insurance against the climate chaos. And over $1.2 billion payouts have disbursed through sovereign risk pools 2007, helping the governments to deliver your rapid liquidity within weeks of disasters. This is again as per World Bank 2023 reports. Concept is primarily around the sovereign risk. Catastrophe risk pooling is going to allow the countries to jointly manage your low frequency, high severity climate risk through shared insurance facilities, and this can be across the countries by aggregating a risk in terms of diversification such as geography and peril types, lower reinsurance premiums via pooled negotiation power, faster liquidity for your emergency response and recovery. The structure and mechanism around it is in terms of your participating governments are going to pay annual premiums into a regional pool, and the structure which has been structured as a mutual insurance for as a special purpose vehicle, and this pool is going to then the parametric triggers where the payouts are going to be based on objective data such as wind, speed, rainfall, seismic activity. The reinsurance and capital markets such as catastrophe bonds are going to provide you the backstop layers, expanding payout capacity beyond member premiums. So example can be CCRIF, SPC covers hurricanes, earthquakes, and excess rainfalls for 24 Caribbean and Central American countries. And the benefits and the strategic value are immense, because this is going to enable your financial resilience, because now you have got a payout within days, reducing the need for costly post-disaster borrowing. There's going to be a strengthening of the creditworthiness by reducing contingent liabilities on the government balance sheet. You're facilitating regional solidarity and cooperation, because now you have got an improvement in terms of collective bargaining with the reinsurers, and the countries are now able to support policy alignment with national adoption of plans and climate resilient infrastructure goals. Therefore, the innovations in next generation directions are very important, because this is where the emerging pools such as CDRIF and ARC are integrating forecast-based financing and AI-based hazard modeling, and the integration with sovereign green bonds and resilience-linked debt instruments is being explored to align with the premiums and the various ESG goals are concerned. So some models, they're now being embedded into the climate adaptation credits, with where the investment risk reduction in terms of is going to lower the future premiums, and it's going to create a feedback loop between your adoption and affordability. And there's going to be a complete challenge that the thing has to be overcome in terms of the policy consideration, which is going to require the accurate catastrophe modeling and transparent governance and ensuring your fair premium allocation takes place. Smaller economies may still need donor premium subsidies to participate sustainably. Moral hazard concerns are there. There's going to be a reliance on payouts, and this can deter your long-term adoption unless it has been tied up to the verified resilient investments. There's going to be a need for integration with natural disasters risk financing strategies. And some of the examples in this case can be one is CCRIF, which is since its inception, CCRIF SPC has made over 60 payouts totaling about $275 million to the very member governments and states are concerned, and the average payout time has been around 14 days post the event itself. So the next thing in the similar lines is around the pooling of the strength, in terms of the catastrophe risk pools that have been created. Because when the disaster is going to strike, the entire nation, then the resilience is no longer going to be, it's going to be a one nation's problem. It's going to be across the region, and the rationale is going to be around protection against the systemic shocks, because disasters like hurricanes, floods, drought, they often impact the entire population across the board simultaneously, creating a systemic fiscal stress and liquidity crunches. So the sovereign catastrophe pools are going to spread this risk across the board and resulting in the regions, and ensuring that no single government is going to bear the brunt and the climate shock around it. Therefore, the regional diversification is going to reduce your claim correlation, allow the pooling to operate more efficiently than standalone as a national insurance program, because the mechanics for the regional diversification is going to combine your multiple countries with different risk profiles and the pool benefits, non-correlated hazard exposures. There is going to be a diversification which is going to allow the pools to negotiate better in terms of from reinsurance perspective, enhance the climate efficiency. Model-based parametric trigger is going to ensure that the payouts are based on measurable hazard data so as to avoid the delays of traditional claims process, because the rapid liquidity and the financial stability is going to be very important. So the pools such as CCRIF, SPC, ARC, they are going to provide you payouts within 2 to 3 weeks post disaster, which is going to be much faster than any international aid. And these payouts are going to serve as an immediate liquidity, enable the governments to fund emergency responses, stabilize your financial operations through quick disbursement reduction, resulting in the reduction of loss amplification and preventing the cascading of the social and the economic disruptions that might be taking place. The fiscal and the macroeconomic benefits are going to be immense. So let's look at the three important ones. One is the reduction in the budget volatility and contingent liability exposures from climate shocks. 2 is the support creditworthiness and the debt sustainability as a rapid payout, reducing the need for the emergency borrowing. And 3 is acting as a pre-arranged financing instrument in complementing sovereign disaster risk financing frameworks such as your catastrophe bonds or even contingent credit lines. And when you look at it as an example, the CCRIF, CFC from the Caribbean islands is a very, very classic example around this, because 24 member states, they including Belize, Jamaica, and Dominica, since 2007 they have made over 60 payouts, $275 million. On an average, 14 days is the time period you're looking post your event. So forward evolution is taking place, because you're integrating your parametric microinsurance and climate adaptation bonds with the multi-layer protection, and there's the use of AI enhanced hazard models. There's the potential for the cross-regional pools that are taking place, because the catastrophe model bond structure is flowing across the board from the government to World Bank to capital market investors. And the layered shield is the one that is going to be very important for the sovereign pools, risk pools for the financial resilience, because the layered financial protection strategies, they can reduce the fiscal shocks of natural disasters by up to 60%, where you're balancing your liquidity cost and the average as per OECD World Bank 2022 report. So there are actually, if you look at it, there are about 4 different layers. So the first one is about the member retentions, where you're talking about self-insurance, where the member countries are maintaining a retained risk layer, absorbing small and frequent losses, more in terms of incentivizing your cost of the local adoption and the risk management at the local level. It is encouraging your ownership of the climate risk and ensuring there is a sovereignty over this kind of a problem statement, and acting as a deductible only when severe losses are triggering the regional or the external players are coming into picture. So for an example, so the governments are using natural disasters funds or budget contingencies to finance this layer. The second layer in this regard is the pooled risk layer, where the participating countries are contributing to the premiums and to the shared capital pool and allowing your collective absorption of the medium-sized events. So there is a diversification in exposures across the geographies and perils, and there's a risk mutualization mechanism. So some of the benefits include your smoothing of the fiscal volatility across member nations, efficiency in the capital use, enabling your predictable post-disaster liquidity. An example in this regard is CCRIF SPC. The third layer comes with the reinsurance and ILS backstops, where the catastrophic and less frequently risks are being transferred to the global markets through reinsurance and insurance-linked securities, ILS as we call them, such as the catastrophe bonds is another example in this regard. This is allowing the pool to expand the coverage limits while maintaining their solvency, and you're connecting your sovereign risk transfer to private capitals all across the board, particularly capital markets, and you're deepening your financial integration. And the fourth and the final layer in this regard is your contingent credit lines, which is serving as your liquidity, providing you the financial liquidity buffers for residual losses which are going beyond your insurance coverage. So instruments such as the World Bank's CAT-DDO or catastrophe deferred drawdown option, or the IMF's resilience and sustainability facility, they can provide you rapid disbursements post events, post-loan events. Then this is complementing your insurance by ensuring comprehensive financial protection against the tail events and integrating the fiscal and your financial preparedness into disaster risk financing strategies. When you look at it from the strategic benefit point of view, for all the four layers, they are providing you your balance sheet cost coverage and timing of liquidity. Each layer is providing you different types of financial protection. There's creating an incentive for proactive risk management, both from the retainment and the management of the small risk itself. There's going to be a pool of medium risks that have been created with the transfer of the catastrophe events, improvement in terms of the market confidence and sovereign credit ratings through pre-arranged risk, and the encouragement of data-driven calibration and the hazard modeling and the exposure data. So another emerging trend when we see in the similar lines is around linking premiums and retention thresholds to resilience investments and ESG scoring, while integrating of climate adaptation to core benefits such as green infrastructure, where you lower your premium and cost for the future renewables all across the board. And that brings us to another very important point, that this is about the parametric based precision modeling. So because when the parametric insurance can disburse funds within 10 to 14 days, and this is the kind of payout and the trigger mechanisms based on various factors such as indemnity and industry loss indexes and model losses and the parametric approaches that needs to be taken into consideration. So the essence is around the parametric insurance is going to replace your loss verification as well as your data verification. So the payout is going to be triggered automatically based on certain measurable and physical parameters which are exceeding your certain defined threshold. So say the case of when the wind speed goes above 150 kmph, that can be one parameter. Second one can be, say, rainfall greater than 250 mm in 24 hours, or a earthquake which has got a magnitude of greater than or equal to 7 on a Richter scale. This will there to ensure speed, transparency, objectivity for very critical sovereign disaster financing, because the speed and transparency is going to eliminate the claims, the bottleneck, because the traditional indemnity insurance is requiring your field loss assessments, delaying liquidity when it's most needed. Parametric models are going to leverage your near real-time data from satellite sensors, meteorological networks. As a result, the payouts can be made within days, not months itself, and enable your governments to fund, relieve, and stabilize your budgets faster, because the transparency is now being embedded and the trigger parameters and thresholds are being disclosed ex ante, and this is preventing your disputes. Managing the basis risk, where you're aligning your model and the reality is another important point that the parametric approach takes into consideration. The basis risk is there, which is going to be arising when the parametric payout does not perfectly, it's going to not matching with the actual economic condition or the losses, and they are going to manage it through calibrated indices where you're turning the historical data and the loss data, and you're having your granular approach towards mapping that is aligning your hazard intensity with population and the infrastructure data. So thirdly, the multi-trigger structures that are there, where you're combining your primary and secondary indicators with the wind fall and the exposure factors in intensity. So how does this actually trigger work in the sovereign risk pools is an important point to be understood, where because each member country is choosing coverage parameters based on certain exposure profiles, your fiscal tolerance. So take the case of a Caribbean nation as an example. So anything, they're selecting a wind speed index for hurricanes, which is saying that the payout is going to tear at a 150 and 180 kmph speeds. So a drought-prone African nation is going to use a rainfall deficit index, which is going to be calibrated to your local crop yield sensitivities that are attached to it. The payout algorithms then independently being verified and being stored on a digital platform, so as to ensure that there is no duplication of data, there is no manipulation of information. And the strategic advantages are in terms of fiscal predictability, investor confidence, scalability, because the parametric indices can be applied across sectors, agriculture, infrastructure and energy grids, and integration with the adaptation parametrics altogether. So the risk to return is an important factor, because we are tapping now into the capital markets for climate resilience, and the capital markets are interfacing as a disaster risk financing, because sovereign and pooled risk programmings are increasingly tapping into the capital markets through cat bonds and industry loss warranties. And these structures, they are now being transferred into defined layers of disaster risk to global investors, and freeing up the fiscal space for the governments. And therefore, the investors, they are receiving attractive and uncorrelated returns, while the insured entities are gaining rapidly after a predefined trigger events are taking place. So in this regard, one of the important points is the industry loss warranties, ILW, which is bridging your market and the insurance layers. And the industry loss warranties are, they are essentially contracts that are paid out when the total industry loss is exceeding a set threshold about $10 billion. And there's a simpler and a quicker to trade instruments, and they're used as a top-up reinsurance protection. It's very common among the reinsurers, sovereign pools, and the insurers to hedge your exposure to efficiently. So ILWs trigger simplicity as allowing a greater liquidity in the secondary markets. And why does this transparency matter? Because your investor confidence, is depending upon your clear model assumptions, open reporting, credible third-party data. So that brings us to the end of this lecture series on the ESG analytics and green finance. Thank you for this lecture series. My name is Atul Tripathi, and I am an honorary adjunct fellow at National Maritime Foundation. Thank you.